Hi everyone, thank you very much for your interest today. Always good to hear beforehand people who are familiar and people who are not so familiar with Moray International, so I will attempt to keep it relevant for both. On to the next slide, please. An introduction to the Trust. So this is a large global equity income trust, a traditional trust. The size is about 1.8 billion in sterling in terms of gross assets. Predominantly invested in global equities, we make full use of that global remit, which we will come on to. And one thing to highlight is that there is a focus on capital preservation within the trust. We tend to do better when markets are not at all-time highs and everything is looking rosy. So it can be quite an interesting investment from that perspective. The track record of the dividend yield is something to highlight. So we have currently about 4.7% in terms of a dividend yield, which has grown consecutively over the past 19 years. It is differentiated from lots of other global equity products out there and index trackers as well. For example, there is no exposure to the Magnificent Seven. The trust is currently trading at a discount, as many investment trusts are. So from that perspective, some people do consider this to be quite a good opportunity. On to the next slide, please, and we will just start with a reminder about what the objective is. And we speak about this in every single meeting that we speak to shareholders about. So the next slide will just really emphasise what we're trying to do here with this trust. The investment objective is to deliver an above average dividend yield. And in the context of our peers, as decided by the EIC, that has been achieved by delivering a dividend yield of between 4 and 5% consistently over time. We want to both grow that dividend and grow the capital ahead of inflation over time. And we want to do it by having ideally a covered dividend. So we want to pay income out of income that is generated from our underlying holdings. So again, when I mention a traditional income product, that's what I mean. We don't pay income out of capital, we pay it out of income. In terms of the track record on each of these things, it's pretty decent. So you can see that above average dividend yield going back consistently over time. And we have managed to achieve the dividend growth ahead of inflation and the capital ahead of inflation most of the time. It has been tricky as inflation has been higher over the past 3 years or so, but over time, that's something that we have managed to achieve more often than not. One thing to highlight here is that long-term total NAV return of 10% annualised in sterling is a little bit ahead of any general global equity index, but how it has been achieved is very different over time. So roughly half coming from income, half coming from capital over that time. And you will find, given the more defensive nature of our portfolio overall, we can perform very, very differently from a global index, which again, I think is a valuable thing to have. And on to the next slide, please. The next section really talks about, over the last 6 months, what we've been up to, what we've been doing, what has been successful and what has not been as successful. These figures we update twice a year, so we go out and speak to shareholders typically after the full year results are announced, roughly in February of each year, and then after the half year results, which are usually about August time. And this is where we just have a look back over that time period and see what's been going on. It's relatively easy for us to do this because we don't have hundreds and hundreds of stocks here. We have roughly 50 equity holdings in Moray International, so it's very easy to identify what's been going on. We always have a high degree of dispersion in terms of how the underlying holdings are performing, and that's something that we're happy about because we never want all of our stocks to do well at the same time because they will all do badly at the same time. So You will always see a range of performance in the underlying investments, both from a country perspective and also when we go on to look at the sector performance. But just over the last 6 months or so, what has worked has been some of our Asian equities, and particularly some of the technology companies within that category. So tech isn't something that's necessarily associated with an income portfolio, but we can and we do manage to find exposure there, and we do manage to find exposure there in lots of different regions, not just the US. So within Asian equities, one stock, for example, Honhai Precision, it doubled actually year to date. Another name, TSMC, which is probably more familiar to people, Taiwan Semiconductor, another very strong performer over this time period. So that was part of the reason why we had very strong performance from Asia. North American equities, another strong category for the trust. Again, some technology exposure in there performing pretty well. At the opposite end, you will see we do have an allocation to Latin American equities. And I should highlight that all of these positions, all of these weights are a byproduct of where we're finding stocks that we like. So it's all driven by stock picking with a common sense overlay to make sure the trust is always well diversified. And within the Latin American equities, what we have seen there is some of the more cyclical areas of the market, and our holdings have been a bit weaker. Now, these have been very strong performers up to this point, so we're not surprised that they have come off. They've been a bit weaker this year. Over the page, please, you can see that we do also have a lot of dispersion when it comes to stocks, breaking it down by sector. So technology has been a very strong market category. Actually, our stock picking has been even better than the MSCI All Country World, for example, despite not having any of the Mag 7. So because we have things like Honhai, TSMC, Broadcom in the US, for example, and they have all performed very strongly, that's what's behind this 40% return in sterling from our technology names within the trust. And one question we're often asked is, is there not a place to have an NVIDIA or a Microsoft or an Alphabet or an Amazon, these types of names in Murray International? And the answer is no, not at this point, because going back to what we're trying to achieve, that income and that capital growth, we need each and every one of our holdings to contribute to the income story, and these stocks at the minute just aren't suitable. But it's not to say that we can't get exposure to really quite significant, exciting areas of the market like AI, through other technology holdings like TSMC, like Honhai, like Broadcom, for example. Other categories such as industrials also performing pretty well. Stocks such like Atlas Copco is a Swedish industrial company we own, performing very well. We have names that you probably won't have heard of. Grupo Asur, for example, is a Mexican airport operator which falls within industrials, which had a very strong start to the year. And then, as I mentioned previously, some areas of the market such as basic materials, consumer discretionary, not performing so well. But again, if you had looked at this slide 2 years ago, it would have been exactly the opposite in terms of what was working and what had been a bit weaker. On to the next slide, please. This really just highlights the fact that some stocks have been weaker and some stocks have been stronger over that time period. Commodity stocks in general have been weak. One thing to highlight is looking at Vale and BHP and SQM, which is a Chilean mining company. We're mindful of the weights in some of these more cyclical, more volatile names. So we have 4% in total across these names, these weaker names. And even although the capital side has been weaker, the dividends, the income that they are providing means that we still think that these are valid holdings. And as I say, they're cyclical. They will come back again at some point. Over the page again, this is the good news story. The tech names, they have been phenomenal performers, some of these companies, to the extent that we have taken quite a bit of money off of these names. So in Murray International, we have a minimum of 1% and a maximum of 5% in any one stock. And a few of these names, including TSMC and Broadcom, have consistently been bumping against that 5% maximum limit this year. So we have been trimming these names really quite aggressively to make sure that we abide by that rule. Not complaining about the performance, but it has meant some top slicing. And then on to the next slide, please. One question we're often asked by investors is what we do, if anything, with currency. So this is a truly global trust. It has quite a small position in the UK presently, about 5% of assets. So therefore, you have an awful lot of moving parts when it comes to assessing what the currencies are doing. And we do just accept that sometimes this can work in your favour and sometimes it can work against you on the currency side. Sterling's strength in the first 6 months of this year has been a negative, but it's actually continued to be so since the end of the first half. Things like the Brazilian real, the Mexican peso have been really quite weak against sterling. Now we have quite small exposures to these currencies that look the most dramatic. So for example, we have 3% currently in Brazil, 5% in Mexico. The currencies which we have higher exposures to, like the euro and the US dollar, haven't been nearly as volatile or as weak against sterling, but it is something to be mindful of. Sometimes this will have an impact on whether we have a covered dividend any one year or not. One thing to mention on this is that we do have very healthy reserves at Murray International. So as much as we would love to have a covered dividend every single year without fail, there are sometimes years where, you know, things like this come along, a currency move, or COVID was a very strong example of that we don't manage to achieve the income that we need to pay out the dividend. And that's where we can and we do sometimes dip into reserves. So being such an old and well-established trust, Murray International has been around since 1907. We have, over that very long time period, managed to build up a reserve base of £73 million, which is roughly 1 year's worth of dividend payments to our shareholders. So as and when we do have to dip into that for a variety of reasons, it's there for that purpose. Moving on to the next section, please. You can see the net earnings per share and the dividends per share for Murray International over time. And this highlights that point about being able to smooth out the dividend payments because of the reserves that we have. So pleasing to see that even though we did have a dip in 2020 and 2021 in terms of earnings per share, the dividend we were still able to increase over that time. And in the 2 years after that, 2022 and 2023, we still managed to pay out a growing dividend, but also replenished those reserves somewhat. So it's a benefit of being so global, so diverse as well, that we do have that ability to not be hit maybe as hard as you would have expected, even in something like COVID that was so dramatic, because not everywhere was impacted to the same extent in terms of companies being able and willing to pay dividends. So that track record, that kind of solid, steady dividend growth is something that I think is very valuable for our shareholders as well. On to the next section, please. And this is where we can look at changes to the trust. So it's a buy and hold approach. And we have companies in Murray International that we've held for 20 years, believe it or not. And we do change the weighting in those names. It's not necessarily that the weighting is the same and static. But in terms of changes, it's got to be driven by the stocks. And you can see that we have been doing a bit more selling than buying in the first half of this year, partly because we raised some money to pay back some debt. So we do have some gearing in Murray International, not a huge amount. We currently have about 6% gearing as a percentage of our gross assets. And we paid back some debt that was up for renewal, because whereas we were paying about 2% on that debt, the quotes were becoming more like 6% to renew it. So as much as it can be useful at times to have gearing, we only have it if it makes sense, if we think we can, without too much trouble, earn quite a decent return on that borrowing. And when the question is not an obvious yes, it's very nice actually to be able to say thanks, but no thanks, we'll pay it back. So we did that with 30 million of our debt in May of this year. And that leaves us with 110 million of debt, half of which is up for renewal in 2031 and the other half in 2037. And we're paying a weighted average of 2.57% on that debt. It's based in sterling also. So that's quite a nice position to be in. So more sales than buys, partly for that reason. We sold 4 stocks in total, which leaves us at the moment with 47 equity holdings. And we sold them for various reasons. So Roche is a company we had held for a long, long time. It's a pharma company, a Swiss company. That's fine. It wasn't this company was a disaster, or it was, you know, something that we were really desperate to get out of. But it's a stock that was kind of okay. We have plenty of options in healthcare. We do have quite a high exposure there. And Roche is a company that's no longer, I think, as high quality as it once was. It used to be the cancer expert, the oncology expert in the world, and it's no longer got that title, as lots of other companies have actually stepped up and really diversified and came up with brand new ways to treat the disease. So it doesn't quite have the same caliber as before. The dividend yield was okay, but again, nothing special in a healthcare context, so we sold out of Roche. China Vanke is one that we got wrong. So China Vanke is a Chinese real estate company, and we went into this one with our eyes open. It was a small position, and we thought by going into one of the higher quality names in that sector that by this time there would have been a bit more of a solution in terms of Chinese property, and this would have been a company that was part of that solution and able to perhaps buy up weaker assets, but that has taken a lot longer and it's still not resolved. So we sold out of that one, and the catalyst for that was when the company cancelled its dividend. It's the one stock that we own that had cancelled its dividend this year, and so we sold for that reason. TC Energy is a company which operates in Canada. It's a pipeline company, and the switch from that into another name, Enbridge, was just for a preference for that name. So we now have one company rather than two within that category. And Epiroc is a name that we sold for the right reasons. So this is a company, it's a Swedish company, it was spun off of Atlas Copco a few years ago now. It produces mining equipment, and it just performed extremely well, to the extent that the valuation in our view was looking quite expensive, and the dividend income from the stock was at the lower end of what we would deem acceptable for the trust. So that was the 4 divestments. One new stock into the trust, which has generated quite a lot of interest, Mercedes-Benz, we bought in February of this year. And again, we went into it knowing that this was probably not a stock that was going to work straight away. The area of automobiles is notoriously difficult, but I think for this company, it has done the right things. So sort of 3 or 4 years ago, it's simplified its business. It spun off its trucks and its buses business. It definitely went more high end. It has improved margins and improved cash flows on the back of these changes. And we think that over time, that will be rewarded. It does have exposure to China, which is why it's been one of the reasons why it's been a bit weaker since we bought it. But there's more to it than just China. This is a truly global company, and the thing that really made us get over the line on this one was the strength of its balance sheet. It has a net cash balance sheet. It is on a 9% dividend yield, and that is absolutely rock solid in terms of if you look at its cash flows. So while you're waiting for the capital side to come good, you're being paid a very attractive income in the meantime. And the other trades there, the top ups and the top slices, we typically do take money out of stocks which have run up quite hard, some of the tech names I mentioned previously, and adding at the same time to some names which have been a bit weaker, things like Pernod and Diageo, which we bought this time last year. The next slides really just give a bit more information on that. I won't go over them because I've spoken about them, but Epiroc has been a good performer, so we sold out that one. And then if we continue in the slides, please. And again, thank you. Again, more information on Mercedes-Benz there, but really the next section is talking about the range of different companies that we can invest in for Murray International. We're very lucky, I think, to have the global remit and to have a barbell approach to that income story. So it's absolutely not the case that we need every single investment to have a yield of 4.5% because that's what we are seeking to pay out. We do have things like Broadcom, TSMC, BE Semiconductor, in that technology space that contribute to the income, but they're at the lower end of that range, and it's offset by other names which are higher. So things like we've got 2 tobacco companies, Philip Morris International, British American Tobacco. Some of our financial holdings pay very nice, healthy yields. OCBC is a good example of that, a Singaporean bank. So you're looking for a range of different companies at all times, which just means that, again, over time, you've got lots of different moving parts within the trust, which is ideal. And we put in for the first time this year on the next slide, a mix of where the income is being generated from. So again, it highlights the fact again that we don't need everything to work together at the same time. So the income is very well spread. So the top contributor last year was that Mexican airport operator, Grupo Asur, which again is a net cash business. It has a track record of really putting money away for a rainy day. It's coped with, even before COVID, swine flu, hurricanes. This is a business that knows how to be resilient, and part of that is putting cash aside, and it pays very nice special dividends to its shareholders because of that. And we do have, as you see, some of the more cyclical names in there, Valley, Total Energies, for example, which again, in good times are very attractive from an income perspective. And then on to the next section, please. Just keeping an eye on my time here. This is where you can see the spread of the investments. First of all, from a regional point of view, and then from a sector point of view. And I think the trust today is as well diversified as it ever has been. So I've been involved in this trust for 20 years, actually. The names manager for the last 5 years or so. And then taking over, stepping up when Bruce Stout, my colleague, retired in June. But this chart is looking as good as it ever has. So we have a really nice spread of different types of companies in there, both geographically and by sector. And it doesn't hugely change. If you're looking at this and then look at it 6 months down the line, it's not that we do that much trading that you would expect it to be transformed. But even 5 years ago, for example, the European equities exposure was half what it is today. And the catalyst for that change, it's all stock driven, but it was really an interesting time when Russia first invaded Ukraine. You were seeing a real revulsion as to people being interested in investing in certain parts of Europe. So that's when we were more active in that space. And the kind of companies we were interested in, they were global businesses, things like Danone in France, Siemens in Germany. And at that point, we picked them up at really quite attractive valuations. So over time, because of the stock changes, obviously these overall percentages can change, but that spread of businesses is ideal. And then on to the next section, please. This is just a bit of an outlook. It's always the hardest bit because really, we don't have any great insights into this. People can wax lyrical about this section, and really it can be a bit of a guessing game. And again, I think we are very fortunate in that we don't have to operate in just one area. So having the spread of different companies that we have, there's always a quality bias. We like the net cash balance sheets. We like strong management teams. So even if markets have a bit of a wobble, these types of companies tend to be fairly resilient. And there is plenty of looking out still to be a bit concerned about, certainly. So the geopolitical risks just seem to be increasing all the time. I think inflation is still a risk. So as much as it's been coming down, some of the policies that you're seeing in the US, for example, that may be put to work, if depending who gets in actually in the US election, could be inflationary. Any sort of wars tend to be inflationary. So there's still, I think, plenty that would make you kind of scratch your head when you look to see that several markets just now are trading at all-time highs. An awful lot of focus has been on what the Fed hasn't done, actually, just to very recently, and that's been cutting interest rates. But there's been so much attention put on that, and it seems to be that even bad news turns into good news at times. So even after all these years, I still can't get my head around some of that. But the beauty of our trust is that we focus on companies. You know, we're picking 50 companies to deliver the investment objective of the trust, and we really do make full use of the global remit in order to do that. And so I think that's me about out of time. I'm very happy to take any questions that you may have. Thank you.
Thanks very much, Samantha, for a very interesting presentation there. We do have some questions. If anyone would like to ask any more questions, don't forget to click the Q&A button at the bottom of your Zoom screen, and you can enter your question there. So we'll make a start then. So first, we have a question from Tom. Has the approach of the investment team changed in any way following the retirement of Bruce Stout?
That is a good question. Everyone's watching us very closely since Bruce left. So for those of you who don't know, Bruce Stout was the lead manager of Murray International for 20 years. He retired in June. Martin and myself, who are now co-managers, we have been involved in the trust for myself, directly involved for 5 years, Martin for 7 years. So that transition has been very smooth. So the investment process hasn't changed at all. At Aberdeen, we rely on our analysts who are located all over the world. They're the ones visiting companies and coming back with recommendations of stocks that might work for Murray International. And then we do our analysis over and above that to decide what stocks we think are the strongest. The beauty of the trust is that the investment objective isn't mine, it's not Martin's, it wasn't Bruce's. In terms of what we're trying to achieve, that's a shareholder decision, and it's up to the board to make sure that we, as managers, are on the right track with that. So I think we will be scrutinised, and rightly so. People will be making sure that we're sticking to what we should be, as we are relatively new to being the lead managers, but nothing has changed in that regard.
Thanks, Samantha. I'll combine the next two questions as they're essentially similar. So what is the rationale for holding EM bonds, and how is your position size likely to change in the future with the expected fall in interest rates?
Yeah, sorry, I haven't actually mentioned this. So we can and we do make use of fixed income, but very opportunistically. So over the past 20 years, there's only been 2 periods that we've had sizable positions in fixed income. And the most recent one was 2014-15, when we bought these emerging market bonds. And at that time, it was because they were trading at really, really screamingly cheap valuations compared to what we could achieve on the equities category. So some of the yields on these, were kind of 9%. They were trading at 60 cents. I mean, it was just ridiculously cheap. So that's when we went into some of these names. But we have since sold quite a few because during COVID, actually, they held up incredibly well. So the kind of bonds that we were looking at were either corporate bonds, where we thought the quality of the corporates was really good. So we had Valley bonds, for example. We had the equities anyway. So if you're kind of happy with the quality of the equities, you would be interested in the bonds, since they would come first in any real time of difficulty. And we do have some sovereign bonds as well, a mixture of local currency and dollar. We only would ever go into bonds like this if they had already been scrutinised by our emerging markets bond team at Aberdeen. So it's never been the case that Bruce or Martin or myself would just go alone and pick these things. That's not our area of expertise. We need to have them, first of all, held by our experts really within the company. But the weighting now is about 6%. As I say, we sold some during COVID. We sold a Valley bond at 140, which was just ridiculous, really. We put that money into things like Broadcom and AbbVie at that time, which were offering much higher yields and better capital upside, obviously. So the direction of travel has been for it to come down. It probably will come down further because they're kind of in no man's land at the moment. They're not really cheap. They're not really expensive. The running yield on that part of the portfolio is about 8%. So they're good from an income perspective. But we're not adverse to selling some things if they do get really more on that expensive side. And we don't have to have them. As I say, it just depends on what the opportunity set is.
Thanks. Yes, that makes sense. So the next question is about your investment process. You have a very large potential investment universe. So how do you filter that down to the companies that you want to buy, or instruments that you want to buy?
Right. So it's fantastic having choice, but given that there's thousands and thousands of opportunities out there, and we have to come up with about 50. The work initially is carried out by our analysts. So there are 110, I think it is at the moment, regional analysts at Aberdeen, and they spend the bulk of their time visiting companies and coming up with recommendations. And they know that one of the key objectives that they have to fulfill is finding stocks that are suitable for a variety of income products at Aberdeen. So it's no use to us whatsoever if we're just being fed lots of ideas with no income. They know that that's part of their job is to give us ideas that are going to work for these products. So we do have a coverage list of around about, I think it's about kind of 500 names. But if you screen for income, and by income, like again, it's not that we need 4.5 for every name, but the minimum at the moment that we have is about 1.5%. From an income, so then a dividend yield perspective. So again, that gets rid of a lot. And a lot of companies are pretty similar as well. So, you may have OCBC, which we have, a Singaporean bank. We're not going to double up and have UOB and DBS because they're essentially the same kind of companies. So over the years, we've got to know that list really well. And we do screen for quality metrics, things like dividend growth over time. We like to see that strength in the balance sheet. So we'll screen out companies on that basis as well. And now, as it stands, any new company has really got to be a strong contender to bump out something that we already own or to provide something different. So it's never been the case that we've started off with a blank sheet of paper and then had to find, 50 names out of that coverage list that we think are going to work. In reality, it's an analyst coming with a potential new income idea. We will discuss it with them. We also have discussions with other income managers at Aberdeen because it just makes a lot more sense to kind of pool our power in terms of discussing ideas. It's up to Martin and myself what makes it into Murray International. But I'm very interested to hear, what Charlie Luke, who manages Murray Income, thinks of Mercedes, because he also owns it as well. He owned it before we did, for example. So these kind of discussions happen all the time. And that's where, again, part of the selection process comes from, is having these discussions and trying to identify companies that we think are better than what we've got or a bit different than what we've got, and sort of it's a filtering process essentially, and getting to the names that actually are good enough to make it in our view.
Thanks. If I can just ask a supplement to that. You mentioned that the coverage universe of your analysts was 500 companies, if that's correct. That's still a very small proportion of the companies out there. How was that 500 selected? So again, we've become, I think, a lot more efficient in this regard. At one time, when Aberdeen and Standard Life merged together 7 years ago now, that coverage list would have been like in the thousands, not the hundreds. And that it meant there was an awful lot of work being done and coverage in company meetings that were never finding their way into a portfolio. So as Aberdeen has become, or trying to become more efficient over time, and really focus on, well, what kind of companies are we looking for? You can kind of put them in 3 buckets now. It's income, it's like funds with a sustainable angle, and we have small cap and mid cap products as well, predominantly these 3 categories. So it's meant that the coverage list has shrunk with an idea more in the back of the analyst's mind, first and foremost, like, are these ever really going to make it into a portfolio? So
it's not that they wouldn't be aware of other companies. Of course they are. You know, if you're looking at TSMC, Jamie, who covers that as our analyst, is going to be having discussions and meetings with lots of other companies who are peers, who are customers, who are providers to that business. But if I talk about something under coverage, it means there is an obligation on that analyst to write quite a detailed note, to provide detailed feedback on earnings. So that level of coverage is quite a high bar. You have to commit to that as an analyst. So that's the kind of balance. It's like, ideally you'd love eyes on everything, but we don't have infinitely many people, and you want to be to use them well, and to make sure that they feel their work's being valued as well, because you don't want people visiting companies and coming up with what might be a good investment, but it's just not got a natural home in any of the products that we manage, and that would be very disheartening, I think. So I think between the PMs and the analysts, there's a lot more debate as well quite early on as to what kind of companies are going to work. So that's how it's evolved over time.
So there's an initial filtering process that the analysts do in conjunction with the portfolio managers to decide what they're going to cover.
For an analyst, like I had a conversation recently with one of our consumer discretionary analysts, and she had pitched an idea, but just as an initial idea. So before I go and do all this work, is it something that potentially is of interest? And we have a conversation, and that can be a yes or a no. And it helps her to manage her time better as well, rather than going off and doing a lot of work that's really a bit going to waste. So
that's important. I mean, doing a thorough analysis is a time-consuming process.
Yes, indeed.
Thank you. Okay, then Adrian is asking, could you say a little about equity? Well, in fact, I think that's really a repeat of what we've just discussed. So I'll mark that one as dealt with. Okay. Adrian also questions, it says the position size limit of 5% seems a bit low. Have you done any analysis of, quotes, lost profits as a result of routinely selling successful investments? There is the old run your winners
I think
adage.
That is a good one. And we do look at these things. So looking at analysis of our trading, because some of these tech stocks have just continued to do well. So there is lost performance, if you want to look at it that way, from continually trimming Broadcom, continually trimming TSMC. For example, like these two positions, they're currently 4.5%, but just this year we've taken 2.5% out of Broadcom, we've taken 1.5% out of TSMC. So these could potentially, be a lot bigger. But we are willing to give up that lost performance, if you like, rather than become besotted by a stock and become really concentrated. So especially when you have stocks in the same sector, a similar area, all doing really well, they're all going to come out off at the same time as well, probably. So that can still be painful, but it's going to be a lot less painful if they're 5% each rather than 15% each. So I don't think there's a perfect answer to this. You could have run them up harder, you could have got more out of these, but actually at what point do you just get greedy and then you're kind of setting yourself up for a big fall at some point in time? And again, that's not, I think, what people expect in this product. Having that spread of different exposures is something that we actively seek, rather than really kind of putting your eggs all in the one basket and becoming really beholden to a couple of stocks continuing to do well. We quite like having that diversity, like having that spread, even if it means that you could have got a few more percentage points when times are good.
Thanks, Samantha. Yeah, that's similar to my own investment process. I value being able to sleep at night, not having a massive percentage in a small number of holdings. Yeah. Thank you. Okay. Then Adrian also asks, can AI help on stock picking? Is it something you use or your firm has looked at all?
Yeah, not for stock picking. I'm always quite at the tail end with these things. I'm not particularly smart on techie stuff, but even I have started to dabble, but it's more for writing. So or like summarising meeting notes. So it's not for stock picking yet. I mean, maybe it will be at some point or be investigated that way. To my knowledge, it hasn't been for Aberdeen, but Mike, it does save you a lot of time. Just doing things like writing up minutes and even just trying to condense a lot of information. So that has been useful, but it's more making you work more efficiently rather than trying to replicate what you're doing on the stock picking side.
Right. Then Ray asks, what is your portfolio turnover and active share? I'm not sure what index you benchmark.
Yeah, so actually,
against.
Have an official benchmark. We have a reference index, which is the FTSE All World. And against that, the active share has consistently been about like mid-90s, like for ages. So it's very, very different from anything else really out there, including the index. Sorry, what was the first part of the question? That was active share.
Portfolio turnover.
Turnover again. So this can change just depending on opportunities. So last year it was 7% of assets was a turnover, so fairly low. What you will see is when there's a real shake up in the market, like we were actually pretty active in COVID times, but the market, if you remember, like really fell and then really bounced back again. There was a 6-week window in sort of March, April time 2020, and we introduced quite a number of stocks then, maybe like 3-4 new names then. So it does vary just depending on what markets are doing. And this year, just in the first half of the year, it was 8% the turnover, which again for a half-year period is fairly high for us. But half of the sales that we did was this forced selling in a way, top slicing all of those stocks that had bumped against the 5% maximum. So obviously, like there's not one figure, but that kind of number, between a kind of 7% and a 15%, for example, would be the range that we would think is fairly normal.
Okay. Okay, the next question is actually the same, so we'll get rid of that one as well. Relating it to the Magnificent Seven, but it's asking about active share.
Yeah.
Okay. Then Gerald is asking about Forex. Now, I understand from your presentation that you don't hedge currencies and you just take the currency risk. Is that correct?
That's correct. We don't hedge.
Yeah, right. So the answer is you don't manage Forex. Yeah.
We do think about it from time to time because on the face of it, there is 5% in the UK, 95% in other currencies, but we have, I think it was like 22 different currencies we're invested in. If you were trying to do that, and even the timing of the dividends, it's not like you get them all at the same time, so then you can set up a hedge on that day. They really do pay throughout the year. And the cost of doing that, the complexity of doing that has just meant that we've not gone there ever. And if you look at it over a long period of time, over 20 years, in any attribution report, the contribution from currency is negligible. So you might feel at times like, oh, this is really painful, or on the opposite side, you can get a real boost from currencies. It really comes out in the wash if you look at it over a decent period of time. So no, we've never hedged the currency side.
Thanks, Samantha. Okay, just remind people there are no other open questions from delegates. There's one that I might ask if you don't mind.
Of course.
But if anyone else would like to ask any more, do continue to type them into the Q&A box. I noted that your dividend policy, the fact that you only pay dividends out of income, means that you are constrained to invest in not totally, but to a certain extent in higher yielding equities. Wouldn't you have more flexibility to invest in quality growth companies if your dividend could be paid out of capital as well? So you can.
Yeah, again, it's something that the board have discussed from time to time. And I think it has become more popular as markets have been generally on the upward trend over these last few years. But the difficulty does come when markets aren't.
When things go the other way, yes.
And I think having this very clear message is important to people so they know what they're getting with Murray International. They know about that covered dividend objective. And as it stands just now, we can have 1.5% yielders. So actually, if you're looking at the range of companies you can have for that as a minimum, we've never been in the situation that we haven't been able to get diversification, or we haven't been able to get companies that, even like in AI, the kind of areas of the market that you think are going to deliver on the capital side. There's always been a way to play that, but with this objective of every single company that we invest in contributing to the income up to a point. And it does change. It's really interesting. So Broadcom, one of the stocks we own in tech that's just like a low yielder just now, 1.5%. When we bought this, that was one of the names we bought during the height of COVID. And when we bought it then, that was a 7% dividend yielding stock. So it fluctuates hugely. So I think that's why we do keep an open mind. You know, it's not to say that a 1% yielder now is always going to be a 1% yielder. So the dividend growth is really important as well. So as much as we'll look at what the yield is, but having that willingness and ability and commitment to growing a dividend is important for us as well. But I think kind of looking at it and finding companies that way and basing how we run Murray International in that regard, it just makes people hopefully kind of sure about what they're buying into. And then there's plenty other options for them if, you know, they want to go down the route of paying income out of capital. So we don't feel constrained, I guess, is the conclusion, by doing things this way.
Okay, yeah, nice. I suppose it increases the chances that you'll be able to maintain and grow your own dividend,
I think, again,
say, because
so valuable for our shareholders. So nowadays, a 4.5% yield, you know, you can get that from a variety of different products now, but that has not always been the case. I don't think it will always be the case going forward. So showing that chart at the very beginning where we've managed to do that over lots and lots of different types of market environments over time, and because this is how we do it, gives people that confidence, I suppose, that they might not otherwise have.
Great. Okay, well, that's been very interesting, Samantha. Thanks very much for the presentation, answering all the questions and for your time. It's really appreciated. Thank you.
Thanks much. Take care. Bye-bye.
Bye for now.